Imagine you've just won a contest and the prize is quite unusual. Instead of a lump sum of cash, you're told you will receive a fixed amount of money, say $100, every single year, and this will continue not just for your lifetime, but forever. This, in essence, is what we call a perpetuity in the world of finance. A perpetuity is essentially a stream of equal payments that goes on indefinitely, meaning it never stops. Think of it like a river that constantly flows, providing a steady supply of water, or in our case, money, without ever drying up. It's a theoretical concept, of course, as nothing truly lasts forever in the real world. However, it serves as a very useful tool in finance for valuing certain types of investments or cash flows that are expected to continue for a very, very long time, practically speaking, into the indefinite future. Now, you might be wondering how this differs from something more common, like an annuity. Annuities are also a series of payments, but they have a defined end date. Imagine a loan you take out to buy a car. You make regular payments for a set period, say 5 years, and then the payments stop. That's an annuity. Perpetuity, on the other hand, is like that same payment stream, but it never ends. It's as if you are getting paid interest on a principal amount, and you only ever receive the interest, never touching the original principal itself. Think about a scholarship fund that is set up to provide a fixed annual award to a student each year. If the fund is designed to operate in perpetuity, it means the earnings generated from the initial donation are used to fund the scholarship award year after year, forever. The original donation, or principal, remains untouched, continuing to generate income. This is a real-world example that gets close to the idea of perpetuity. So, how do we figure out the value of something that's going to pay out forever? It might seem impossible to put a price tag on something that never stops giving. Actually, there's a surprisingly simple way to estimate its present value. The formula is quite straightforward. You take the periodic payment amount, let's say that $100 per year in our earlier example, and you divide it by a rate called the discount rate. What is this discount rate? It's essentially the rate of return you could reasonably expect to earn on an investment of similar risk in the market. It represents the opportunity cost of having your money tied up in this perpetuity, instead of investing it elsewhere. For instance, if you believe you could earn a 5% return on other investments with similar risk, then 5% could be your discount rate. Let's put this into action. If our annual payment is $100 and our discount rate is 5% or 0, 5 is a decimal, then the present value of this perpetuity is $100 divided by 0. 5 to 5. This equals $2,000. This means that receiving $100 every year forever is, in today's dollars, worth approximately $2,000, assuming a 5% discount rate. Why does this formula work? Intuitively, it tells us how much money we would need to invest today at the given discount rate to generate that same periodic payment forever. If you invested $2,000 at a 5% annual return, you would earn $100 in interest each year. You could withdraw that $100 as your payment, and the original $2,000 would remain untouched, continuing to generate $100 in interest the following year and so on, indefinitely. Perpetuity is a powerful concept in finance, especially when evaluating investments that are expected to provide a consistent stream of income for a very long time. While true perpetuities are rare in practice, understanding the concept helps us analyze long-term investments, assess the value of stable cash flows, and make informed financial decisions. It helps us think about the long game and the enduring value of consistent income streams.